So let me ask you something. Why accept 14% return when you can get 81% for almost the same risk? In today's video, I will illustrate the advantages of poor man cover call strategy for your portfolio, comparing it to simply owning the stock and a traditional cover call. Let's dive in. Today was a green day in the stock market for me. Let's jump quickly to my spreadsheet here. We will compare owning the stock versus cover call versus poor man cover call. For today's example, we are going to use Tesla shares. Let's go ahead and see how Tesla is doing today. So if we went to Tesla today is 175 point something. During this tutorial, we'll assume Tesla is 175 just to make the math easier. Let's go back to our spreadsheet here. Let's start with the stock. If we were said to purchase 100 stock of Tesla at 175, that will add up to the amount of 17,500. Now we're going to take a at the different scenarios that can happen from owning the stock, how you're going to benefit and how you're going to lose. If the stock have rallied to 185, that means it's a $10 profit on each stock multiplied by 100, resulting in 1,000 profits. So what if the stock went to 200? Then that's $25 rise in the price multiplied by 100 share for each option, resulting in a net gain of $2,500. Now let's take the other side. If the stock dropped to 165, that's a loss of $10 per share, resulting in a minus $1,000. In the final scenario, if the stock went down to 150, which is a deep dive, like you are losing a $25 per share, multiply that by 100 share, that's a minus $2,500. We all know that, we all experience that. That's the normal stock and how it will act based on the price in the market, one day up, one day down. Now let's go ahead and take a look if we bought the stock and sold the cover call on it. In this example, I'm going to sell a 200 strike in 4 months. So if we go back to Tesla, we went and press on trade Tesla. We make sure that we are on the call and choose sell. And then we go and change the day to October 18. If we went to sell the 200, as you can see here, we will collect a credit of 1,325. To make simple math, in our example, we'll assume we're only receiving 1,300. So let's go back to the spreadsheet. We're going to sell the $200 strike price again. Our investment amount will be the $100 multiplied by the 175, which is the share price, resulting in 17,500, minus the 1,300 premium that we just collected from selling the cover call for 4 months, resulting in a total cost for this investment being 16,200. Now let's take the different scenario and see how it's going to act if the stock moved up or down, just like what we experienced with the stock. So in the case the stock went up to 185, in this case, we will collect the $1,000 from the stock appreciation, similar to what happened with the stock. And on top of it, we'll collect the 1,300 from the call, because in this case, the cover call will expire out of the money and we get to keep the premium. This will result in a total gain of 2,300. As you can see, it's higher than 1,000, which is great for us. Now let's assume the stock went up all the way to 200. In this case, we will collect, similar to the stock, the 2,500 plus the 1,300, resulting in $3,800 gain. Again, it's a better result than just owning the stock. Now let's take the downside. In the first scenario, the stock go down by $10 to 165. We will lose $1,000 for the 100 share, but that will get offset by the premium we collected. Since we sold the cover call for 4 months and we collected the 1,300 premium, in reality, we're going to be positive 300. This is thanks to Tesla high IV, which generate high premium. Let's take the last scenario here, which is the stock down to 150. This is a big down. In this case, we'll lose the 2,500. Again, it will get offset by the 1,300 premium that we receive from selling the cover call. However, because the stock went down a lot, we will still end up with a loss of 1,200. Now we saw the first scenario for the stock and the second scenario for the cover call. Let's jump in and take a look at the poor man cover call. In the poor man cover call here, we are going to buy the 150 that expire in 1 year. And simultaneously, we are going to sell the 200 strike for the October 18. That means it's in 4 months. We are selling the same call that we sold in the second scenario. So let's jump back to Tesla quickly. Let's go ahead and go all the way to January. Let's change this to buy and go back to the 150. We're going to say we are buying this call. Here you can see all the information about it. We are going to jump back to October and change this into a sell. And we are going to sell the 200 one more time. So you can see here that this is how much we are paying to buy the 150 call. And this is how much we are receiving for selling the 200 call. Our total cost will be almost 3,000. So to make the math easy, again, we're just going to use the number 3,000. So here we're going to say 43.25 minus 13.25, resulting in 3,000. So as you can see, the investment amount is much lower than just owning the stock or owning the stock and selling a cover call on it. So let's say the stock went to 185. How are we going to determine how much we are going to make with the poor man cover call in this scenario? So in this scenario, let me introduce you to my favorite site, or one of my favorite sites when it comes to options. It's Option Profit Calculator. We're going to come here. We're going to choose the strategy poor man's cover call. Let's press on it. So to start with it, you're going to have to enter the simple TSLA for Tesla and press on get price. We're going to go and buy the deep in the money call. We're going to press on select options. We are going to choose the long call that we are buying. In this case, I want to buy the January 17, 2025. We're going to go on the call side, which is on the left. As you can see, the right is the put. We're going to go down and search for the 150. And we are going to choose the mid price between the bid and ask. In this case, it's going to be 43.20. After that, we're going to go on the short call and select the option. We said we want to sell to October 18, and we're going to go on the call and go down to the 200. And also we're going to choose the midpoint between the bid and ask, 13.25 in this case. Here we can add the range for how much we wanted to expect the price at the expire of the short call. I'm going to choose a big range. Let's say 100 to 250 to give us all the scenarios that might happen, and press on calculate. And look at this. So as you can see here, it has a lot of possibilities until the short leg of our poor man cover call option strategy expire, which is in October. Let's go back to the spreadsheet. So we are searching what is going to be our net gain if the stock end at 185. So in this case, let's go back. Let's search. This is the 185, and at the end, it will be 1,149. Let's just round it up to 1,150. So as you can see, the profit is a little bit lower than having a cover call scenario. The reason for that is if we went to the option, we are buying the 150 with a delta of almost 75, meaning we are getting 75% of the change in the underlying stock, which in this case, the Tesla stock. However, with the short call expire, the sell 200 call at October 18, we are able to sell a new call against our buy for anywhere between month to 4 months, because at that time we will have 4 months left in our long leg. Let's continue and see what happened if the stock went up to 2,000. Let's jump back to our site here and look at this. If the stock ended at 200 by October 18, our profit will be 2,450. Let's take a look at the downside now. If the stock dropped to 165, we're going to come here and see our loss will be approximately minus 400. And then we want to also check what happened if the stock dropped to 150, which in this case is going to be minus 1350. Finally, let's take a few extreme cases for the stock going up higher and down higher before discussing the result for all three. So if the stock went up big time all the way to 250, in this case, having just the stock will result in a 7,500 net profit, while going down to 100 will result in a minus $7,500. As you can see, you get the full gain and you get the full losses. In the cover call, our wins here are limited to 200 since we sold that cover call plus the premium that we collected. So it's going to be 2,500 plus 1,300, resulting in a 3,800 profit. If we took a look at what happened if the stock dropped to 100, in this case, it will be the $7,500 loss offset by the 1,300 that we collected as a premium, resulting in a minus 6,200. To find the result for poor man cover call, let's go to the side, take a look at the 250. You see our profit here will be 2,200. And you can press on it to see more details if you want. Now what happened if the stock dropped to 100? In our poor man cover call, this will almost destroy our call that we did, the long leg in our strategy. So as you can see, it's going to be a 2,900 losses. Meaning, you see, there's only $93 left in our long call. So this is what we're saying. Let me repeat it one more time. In this case, the sell 200 call have expired out of the money, and the buy 150 became so far out of the money that doesn't have the value. We bought it for 4,325. It will most likely worth $100 or less. According to this, it might worth $93 only. Why do we like the poor man cover call? Well, as you can see, the poor man cover call has limited our losses significantly compared to owning the stock or owning the stock and selling cover call. Now, one more thing I want to bring it to your attention, which is your profit percentage. If we open a calculator and we take the 1,000 in the first scenario and divide it on the 17,500 multiplied by 100, it means we are getting a return of 5.7 for these 4 months. And if you divide it on the 4 months, it will be 1.42 per month return. Similarly, let's quickly take a look at the cover call. The cover call improved a lot compared to just owning the stock. It will be 14.19. And if you divide it on 4, it will result in 3.54 per month. Much improvement compared to just owning the stock. Now let's take a look at the poor man cover call. The return is lower. However, remember that your investment here is only $3,000. So you divide that on 3,000, multiply by 100, and look at that, 38.33% return. Even you divide it on 4 months, it's going to result in 9.58%. Absolutely amazing. With a small investment amount, you were able to generate a much higher return percentage. Let's quickly take a look at the $200 scenario. Again, 2,500 divided by 17,500 multiplied by 100, resulting in 14.28. Divided on 4, resulting in 3.57 per month. It's very beautiful. You can see in the cover call is going to be 3,800 divided on 16,200, resulting in a 23.45% total return in 4 months. Now, if we divide it on 4, we will get 5.86 per month. Now, finally, let's take a look at the poor man cover call. 2,450 is our profit in the 200 scenario. Divide that on the 3,000, resulting in 81.66 for 4-month return. Divided on 4, that will give you 20% return per month. It's amazing, man. If you know anything about compound interest, which since you are here, I really hope you do, just having 1 or 2 extra percentage in your account will cascade so big over the long term. So having a small amount of your money in the poor man cover call will help you generate a bigger return. So let me ask you something. Why accept 14% return when you can get 81% for almost the same risk? Let me add one final thing to clarify where is the biggest risk in the poor man cover call. In the poor man cover call, you run the risk of losing all your premium or all your investment compared to the cover call or a stock. When we lost $7,500 here, This $7,500 created less than half the amount that we invested. Since we invested $17,500, the $7,500 was 42.8%. Compare that to the $2,900 that we lost in the poor man cover call. The amount might seem smaller, but in reality, we lost 96% of the money we invested in this strategy. Since all the amount we invested is $3,000 and we lost $2,900, there isn't much left for us to reinvest again in a different stock. So in the poor man cover call, there is a tiny risk of losing almost your entire investment here. That's why we only want to allocate a small portion of our portfolio to this strategy. Although it's good and successful and it gives you protection to the downside while collecting most of the profit to the upside, you do have a tiny risk of losing all your capital investment. If you found this video useful, please consider giving it a like, subscribe to the channel, share it with friends and family, and then if you have a question, please drop a comment. The information provided in this video is for educational purpose only and should not be construed as a financial advice. Investing involves risk, including the potential loss of principal. And if you haven't checked my video about poor man cover call or benefiting from the high IV for PLTR and Tesla, I will link it in the video. See you there.